Good afternoon, everybody. It looks like the rush has become a trickle, so we're going to go ahead and get kicked off here. Thanks for joining us today to talk about maximizing forgiveness in the Payroll Protection Program. My name is Ed Orlett. I'm NAED's Senior Vice President for Government Affairs, and we are joined today by a couple of our friends from St. Louis-based consultancy, Brown, Smith & Wallace. We have Jen Baca and David Killian, who are going to guide us through this odyssey, the latest episode in the continuing saga of the Payroll Protection Program. It's a wildly popular vehicle that the federal government put into place in response to the COVID outbreak. Now, obviously, we're all worried about our families, our friends, our coworkers, our customers, making sure everybody's healthy and safe, and we certainly hope all of you are out there. And thank you for looking to us for information on this issue. We're worried about everybody staying safe, but we also have to worry about our businesses and our ability to continue to operate. Now, having said all that, today, I think in the words of the execrable Don Henley, it's all about forgiveness. So many of you have received your PPP funds, or you may be in line to receive your PPP funds. And you're rightfully worried about the government's promise to forgive much of what they have so generously lent you. As with any government program, your skepticism comes from a place of wisdom. And our focus today is going to be on your questions about forgiveness of the PPP loans. However, any questions you have about government financing, government bailout programs, if you will, and resources to help you fund your business and continue to operate and keep your people employed, that's all in bounds today. If there's a question we come across that we cannot answer on the spot, rest assured we will follow up with you and get you an answer after the fact. A lot of you online today. Looks like we've got 131 people in the room, so it's difficult to have a lot of dialogue there, so we've got you all muted, so no heckling. The way we're going to handle this, so that we'd like to have dialogue on these things to the best of our ability. I see so many familiar names on the participant list that it'd be good to hear from some of you. So to ask your questions, you'll see on your Zoom toolbar, I guess over the last month or so, a lot of us have become much more expert in Zoom than we ever thought we'd be. So this is probably old news to you, but I'm going to go over it anyway. You've got your Q&A button down there. There's a window there. You can enter your questions there. And the thing is, with so many of you and so many questions surrounding this program, a lot of you are going to have the same questions. So we'd ask that you kind of look at the questions that are in queue. And if somebody's asking largely the same question you are, upvote that question and it'll move it to the top of the list so we can answer the questions that are on the most people's minds. Does that make sense? I hope it does. You have the option of asking your question anonymously, although I would ask you to identify yourself, mostly because if we answer your question and you want to follow up or have some dialogue around the answer, that will allow me to identify you in our participant list and unmute you. So then we can listen to all of your mellifluous voices. Finally, I will answer the most FA of every webinar FAQ. Yes, this is being recorded. And yes, it will be hosted on NAED's COVID-19 resource page. And yes, the slides will be available there as well. So having said that, I made a quick reference to our guests today. We'd like to thank Jen and David for joining us. And I'm going to turn this over to them. But, this odyssey that we've been on, guys, has been very interesting. First, we had all this money. We were making all these loans, and we quickly ran out of money. And then there was a little dead period, and then Congress magically appropriated more money without anybody actually being in the Capitol to vote, which is an interesting thing. But so we got more money, and then the SBA portal broke down. So that's probably the only reason why they're not out of money again. But I think, add all that to this rather fluid rulemaking process. And I think the pros on this call understand that the rules are really where the magic happens, right? And that's where this forgiveness is really going to come into focus. And you could be forgiven for not having complete confidence in the forgiveness. So, David, I'm going to go ahead and ask you to take it from here and kind of walk us through your slides. Everybody ask your questions as we go, but we're going to answer them at the end because you're going to find a lot of your questions will be answered during the course of the presentation. All right, so David, take it away.
Will do. Thank you for the introduction, Ed, and certainly would echo a lot of those comments. It's been an interesting ride, maybe is a good way to put it. So today, here's the real question that we're going to be looking at. Most everyone on this website has either received funding or, as Ed said, is in the process for CARES 2 Round 2 that we're in the middle of. So the goal is to address the questions that we know answers to provide our opinion where guidance is ambiguous at this point, and on topics where we don't know the answer, Jen and I are not afraid to say we don't know. So to be continued on those. And I'll touch real quick on our pictures. I know some of you were with us for our last webinar that we did, but this is us on here. I'll let Jen give you 10 seconds on her, and then I'll jump back in, introduce myself, and we'll move on to the objectives.
Absolutely. Thanks, David. And thank you, everyone, for joining us. As David said, hopefully you were able to join us the first time when you were getting ready to get started. I am a partner with the firm, been here, it'll be 19 years this fall, so it's been a fun ride to see everything progress and change. But as David and Ed have both alluded, this has been a very fluid environment. So we will do our best to get you some answers. And as they both said, if we don't know the information, we'll certainly circle back once we do. So I'll let David take back over.
All right, thank you. All right, so today's objectives, we're going to divide these sections up. Jen and I are going to bounce back and forth, and we'll round out with some Q&A of questions and answers that we have seen very frequently that we wanted to address for everyone. And then time permitting, we'll go ahead and let Ed open it up to the crowd, and hopefully we can answer some questions that we haven't answered. So a quick update on loan programs. We'll dive into loan terms as well as forgiveness and documentation. We'll touch on the accounting and tax implications, and forewarning, there are journal entries in there, so please don't fall asleep. We'll move through them expeditiously. How about that? And then, like I said, we'll do Q&A and also point you in the direction of where you can find some additional resources on our website. So, update on SBA loan programs. Odyssey is a great way to put it. And so where have we been since our first webinar? And I think our external BSW webinar, as well as the one we provided for your group, coincided roughly on the same dates. But here's what has happened. Hard to believe this much has happened, but this is what we're looking at. So the interim final rule came out on affiliation, which expanded eligibility and also gave us 4 tests to consider for affiliation purposes. We then had some FAQs for faith-based organizations that related to PPP and EIDL loan programs. Interim 2 came out, provided guidance to self-employed individuals, as well as clarifying how partners and partnerships were to apply. SBA procedural notice on debt relief. So this is an ancillary program whereby existing SBA 7A and 504 borrowers were to receive 6 months of subsidies directly from the SBA. And I want to point this out because with all of the movement in the PPP and EIDL programs, a lot of folks missed this announcement. And hopefully this was instituted automatically by your lender, but this is a payment directly from the SBA to your lender to cover principal and interest payments on existing SBA debt. So a nice little add-on related to that program. Next, we saw a calculation of loan amounts. For everyone laughing that this came out on April 24th. It was only about 3 weeks late, but did give us some guidance for those of us going through round 2, as well as shedded a little bit of additional information on those rules. So followed there, we had a couple more interim rules addressing eligibility for hedge funds, private equity groups, hospitals, ESOPs, as well as a safe harbor certification for recipients of funds who no longer felt that they maybe were covered under those certifications. So anyone watching the news has seen Shake Shack and Potbelly and some of these larger companies that receive funds that maybe weren't the intended recipients. So there is a little bit of a safe harbor there to pay it back if you're having second thoughts. We saw interim 4 released specific to seasonal employers and allowed them to elect a base period of May 1st through September 15th of 2019 for loan purposes. So a little bit of an adjustment there. And then lastly is our ever-growing list of frequently asked questions. All of these documents can be found on the Treasury's website. Like I said, the FAQ is updated regularly, so good source for those documents. And I'm sure everyone is getting inundated with literature from various accounting and law firms as well. So one notable exclusion from that list is the April 26th forgiveness guidance everybody was waiting on, kind of on the edge of our seats to see how the SBA was going to interpret some of this ambiguity in the legislation. Unfortunately, that did not come out. I think part of it has to do with Secretary Mnuchin's comment that loans in excess of $2 million will be audited by the SBA. Our guess is that with the maybe misuse of some of these funds, that they're going to clamp down a little bit more on who received them, how they used them, involvement potentially from organizations like the AICPA as well as audit firms. So Jen and I think that maybe that was part of the delay, but in any event, we're still looking for future guidance. For those of you who applied in the second round, we had the Paycheck Protection Program and Healthcare Enhancement Act on the 24th. So that included an additional $340 billion for the PPP program, as well as an additional $60 billion for the EIDL loan program for those of you who applied for that, as well as the addition of some agricultural enterprises that were added to eligibility. So that was the CARES 2, I guess, quote unquote, that we saw. So, like I said, and Ed commented, an odyssey to say the least. I would like to think we're near the end, but unfortunately, I think we're just beginning. So we'll continue to keep everyone updated and pay attention to what's coming out in the news and guidance and everything. So after that quick update, we're going to touch on some loan terms and some other facets of the funding that a lot of folks have already received. So loan terms. Generally speaking, the act legislated that these should be the same for all borrowers. Of course, check your lending documents to make sure that these are, in fact, accurate. They will govern how your loans are treated. So it's important to pay attention to what's said in these legal documents, albeit long. I strongly recommend reading those and understanding them and asking questions of your lender. So loan term of 24 months, annual interest accrual of 1%, and no prepayment penalty. So to the extent that you have monies left after the forgiveness period, you can pay those back with no prepayment. Loan terms also included a deferral component of 6 months. Please keep in mind that the interest will accrue during the deferral period. However, as we'll see in forgiveness, there is a component of that could be potentially forgiven. So one thing we have done in these slides is blocked out in orange, just some quick tips or things we like to mention related to the rules. So here, keep in mind that interest deferral, timing as forgiveness is key. We're not exactly sure how that deferral will work once the deferral period ends as it relates to interest. So check your loan documents and speak with your lender to make sure you understand what's going to happen should any interest accrual extend beyond the deferral period. And I'm going to pass it over to Jen, who's going to talk about forgiveness and documentation.
Thanks, David. Ed, I know you were kind of waving your hand. Did you have a question that you wanted to highlight or anything in regards to that audit?
I think, well, we do have a question about the auditing, which we can get to during the Q&A period. But as a part of that frequently asked questions document that came out, am I remembering correctly, because some of these clarifications have been delayed and some of these rules have been delayed, that there is sort of a leniency about the rules or what was known at the time of your application is what governs?
Right, and that's what we're seeing in some of these responses, is that you can rely on the data that was available at the time that you applied for that loan. I think what you're specifically referencing is what David talked about the May 7th date. If you feel now with this further clarity that maybe you shouldn't have applied for that loan, and perhaps maybe you got underneath a loophole that wasn't really and you weren't really an intended recipient, then you can actually rely on the information that was available at the time you applied, and basically kind of no harm, no foul, give the money back. And we're not going to maybe penalize you like maybe there could be opportunities for in the future.
Good, thank you.
You're welcome. All right, so we will jump into the forgiveness information, and we'll try to go a little bit quickly, but enough to still give you enough details. The slides, obviously, we'll make those available so you can read those a little bit more at depth at your leisure. So David, if you want to go ahead and advance us. So when does your loan forgiveness period actually start? So you may recall that the lenders will give you the approval, and then they have actually 10 days from approval to disperse your first round of funding. So depending on the size of your loan, your lender might do your funding within a couple of phases. Your active period starts with that first dispersal. So if you received your funding actually with the first round on, say, April 27th starts your first day of your 8-week period. So that loan forgiveness period will be the 8 weeks worth of expenditures after that first round of funding. As David mentioned, the forgiveness is capped to include only the amount of principal and the interest accrued during that time period. So you can never have more than that period actually be applied or eligible for forgiveness. But again, if you did have interest accruing, which you should, during the 8 weeks, that will be included in that forgivable amount. So if we go ahead and go to the next slide. So how are we going to get the forgiveness? So it's kind of been a back and forth. When information first came out, we thought there would be an actual application process. And then it was alluded that most of the documentation would just be substantiation provided to the lender. Now we're kind of back to the process that there really could be an approval or an application process that's undertaken. So it will depend on your lender. So the tip that's down here on this slide, and that you'll hear us reiterate quite a bit, is just to maintain communication with your lender, because they will actually drive your process. So if a lender decides that they have a separate form that they want you to fill out to act as a checklist or a checkoff sheet for the information that they want to have documented in their files, they could certainly do that. Right now, there isn't anything that is issued by SBA or Treasury for those lenders to specifically follow. So again, that's one of those things that we're hoping to have a little bit more guidance on, and I'm sure the lenders are too, so that they can formulate their process. Once you do submit your request for forgiveness, the lender does have 60 days to process and actually issue you a forgiveness letter. And then on their side, SBA has 30 days after that to reimburse those lenders. So the one thing to potentially keep in mind, depending on what your organization's already doing, if you're utilizing any other benefits from the Families First Coronavirus Relief Act, where you might be getting some deferrals of employer FICA credits, things like that, you do want to be cautious of how that overlaps with your forgiveness letter here. So just be aware, and if you're utilizing some of those other potential offerings within the code and within the legislation, just be mindful of when you actually apply. One of the other things, and I forget if we mentioned it this time or if it was last time, but David alluded to that 6-month deferral period. So when you have your loan, there's that 6-month period. So you have your dispersals come out, you have your 8 weeks of qualified expenditures, And during that period, there's no payments required, correct? So you've got that 6-month period. Keep in mind that the lenders have 60 days to approve it. So depending on how quickly you submit your application, you could start pushing yourself further and further towards the end of that 6-month deferral period. So right now, we don't have any guidance that says you have to apply for or request your forgiveness within a certain period. There might be some clarity coming around that, but it would just be something to keep in mind that if you didn't want to incur any payments out of pocket outside of that 6-month deferral, you might want to be a little bit more cognizant of requesting your forgiveness sooner versus later. But again, keeping in mind any other provisions you might be utilizing. All right, if we go to the next. Sorry, I got ahead of myself a little bit. So that's why there is no due date necessarily for the forgiveness, but you will just want to be cautious of everything that you're utilizing, and your lender is going ahead and governing that. The other point, I guess, to keep in mind would be the first round of CARES went very quickly, right? And we're looking at CARES 2 going a little bit more slowly. Ed, I think that's due to, I heard there was some natural pacing that SBA was trying to implement. So I think that was to try to slow it down just a little. But as we've got noted down here in the tip, because there are so many people that receive funding around the same time, it's a lot of applications for forgiveness for those lenders to process. So one might caution that it could take a while once you submit your approval information. So you might want to get on the front side of that. So that way, if you are close to that 60-day time limit that the lenders have to approve, that you don't fall outside your 6-month time frame. So some strategy with timing, strategy with what your lenders are doing, how overloaded you think that they might be, et cetera. So let's go ahead and go to the next. So now we get into, what are our covered payroll expenses and what's going to be eligible. This carries over from our last session. The compensation is your cash wages, commissions, similar items, cash tips if you have it, the vacation and family leave, separation and dismissal. So if you had a severance package go out. And then the kicker here, some of those group health insurance coverages. There's a lot of question in regards to what's covered underneath those insurance premiums. And then if you have the state and local taxes on the compensation. So again, the one big tip here is to keep in mind that you can't double dip, in the sense that if some of those benefits for sick and family leave were paid out underneath the FFCRA, that those cannot be used with your PPP funding. So what are the non-payroll expenses that we can include? So this would be things that are your interest on your mortgages. This would be rent and utility payments, interest on other debt obligations, and if you had an idle loan that got refinanced. Now keep in mind, with all of these items on this sheet, it is something that had to be in place prior to February 15th of 2020. And if we go ahead and go to the next screen, we'll highlight, yep, go ahead.
Let me jump in, because I do see a question here that's related directly to this, so we might as well hit it while we're here. Brian asks, part of the loan is for rent and utilities. Would that also include property taxes?
As of right now, it is not including property taxes to the best of our knowledge. It is intended to be just your occupancy, and there wouldn't be anything similar to that for a lease perspective, as opposed to, owning your own building. The key too is that with these, like with the interest on the mortgage, it does not include a principal payment. It is truly just the interest component on these items. So there's no accrual, no deferral. There's no acceleration. There's no prepayments on things that normally wouldn't be coming into play.
Thank you.
David, did you have anything else you wanted to add on that tax component?
Yeah, one thing I will add is, from a lease standpoint, some lease arrangements, whether you have a full service lease from that down to a gross, modified gross, triple net lease, some tenants will have property taxes, insurance, and common area maintenance baked into their lease rate or added on top, such that maybe you pay pro rata throughout the year and it's ultimately billed out at the end of the year. So from the standpoint of I own my building, I would agree with Jen. There's probably a little bit more gray area that we would need guidance on as it relates to someone who has a triple net lease that is assessed property or real estate taxes on the building. So if we're talking personal property, definitely not, but real estate taxes, it might be part of a lease arrangement. I would say maybe let's see what the guidance says.
Good point. Yeah, that's a great point on those triple net leases.
And then one other, I think, issue right here where we're at is Pam asked if building insurance could be included under the rent bucket.
Yeah, and I think their same answer is with the real estate taxes. So it really depends on your lease arrangement. Again, they're intended to cover occupancy costs, so it's really going to be focused on real property leases, not your copier, for example. So to that one, as well as real estate taxes, I would say maybe, and let's keep an eye out for guidance that speaks to that specifically.
And we're limited to what, 20% on this anyway, on non-payroll costs anyway.
Yeah,
so
25. Yep.
All right, thank you.
Perfect. All right, let's see if we go ahead and go to the next. Okay, so when we, as Ed alluded, we do have that cap essentially of if we are trying to obtain that maximum forgiveness, we do want to have most of our expenses, 75% or more, be used for those eligible costs. And those eligible costs are going to be the compensation limited at that $100,000 per employee. And that $100,000 is on the compensation from a cash perspective. So the $100,000 would not include those extra components of, say, the insurance premiums or retirement benefits. As we alluded to a minute or two ago, the non-payroll costs would not include payments of principal. So it would include that mortgage interest. And if you have other securities or debt obligations that you're paying interest on, it could include those as well, as long as they were in place prior to February 15th, 2020. And as we noted too, that those expenses can't be accelerated or prepaid. It would have to be normally within that normal course of your expenditures. So we've talked about that 25% limit. That 25% would also have an impact on a reduction of payroll from a salary perspective. If you had an overall salary perspective drop of 25% or more, that would negatively impact your maximum forgiveness component, as would reductions in headcount. So if you had any layoffs through the eligibility periods that we're looking at, and those were not reinstated prior to June 30th of 2020, then that would also negatively impact your maximum forgiveness. So there is a rehire exception that allows you to reinstate those persons. And it doesn't have to be on a per person basis. It is just truly looking at it from a full-time equivalent headcount. But if you don't make those reinstatements, then you could be negatively impacted on the maximum forgiveness as well. So the tip that we have down here is the reference to the 75-25 split. So that will be key. There's a couple of theories as to how that's calculated. Again, we're waiting really for some additional guidance from SBA and Treasury on that. There were some theories that the 75% was 75% of loan proceeds. And then there was also a seemingly contradictory theory that it was 75% and 25% of the actual expenditures utilized. So if you didn't utilize your entire loan amount, was the 25% based off of proceeds, or was it based off of the actual expenditures? So there's a little bit of confusion on that yet. So still stay tuned for that component, and hopefully we'll have a little bit more clarity as we continue moving through this, the Odyssey, as we'll allude to it today. We'll go ahead and go next. So the headcount question does arise quite a bit. SBA does calculate the FTE component based off of 30 hours per week. So it is not, necessarily what you would typically think of as a full-time person. Normally you might think of that as 37 and a half hours or 38 hours a week or more, or 40 hours a week. SBA is alluding that it's at 30 hours per week. And then the component for the timing is either January and February of 2020 or February 15th through June 30th of 2019. So again, those are your baseline periods for the average headcount considerations. You would, or we are recommending that you might want to take a look at both of those periods to see which one's going to give you a more advantageous approach. Let's see here. So those base period accounts, those are going to be the amounts that you would have previously disclosed on the application when you were looking at how much your maximum loan could be. For most people, that's going to have been your calendar year ended 2019, December 31, 2019. If you were some of the early applicants, you might have gotten in at that 12-month rolling period when there was some confusion between what was recommended. So you could have had December 31, 2019 as your end of year calculation on that, or it could be a 12-month period, which essentially would have likely ended, March 31st of 2019. The base period for that, though, is going to be looking at your full quarter for which your employees were in place before February 15th, 2020. Yes, Ed.
Hey, Jen, sorry. I got a couple of questions here that I think deserve clarification right now. John notes that DOL considers full-time to be 40 hours a week. And I know that, it is defined different ways depending on the law, right? Like Obamacare defined it differently. So can we have a little clarification around that? I also saw a similar question in the Q&A box.
Yeah, I was going to say, David, do you want to jump in on SBA's component there? They're a little odd.
So this definition, great point about everyone defining full-time equivalent differently based on their legislation. So the definition here is relative to the Small Business Act, which is what generally governs SBA lending. So they define a full-time employee as someone who works 30 plus hours on average in a week. The full-time equivalent is in fact a combination of more than one employee who is not a full-time employee that meets that 30-hour low water mark. So this is a SBA specific definition of full-time employee and full-time equivalent.
So John and Jordan, I hope that is good for you. If not, when we get to the end of this thing, raise your hands and we can have a little more dialogue about that. Sorry to keep interrupting, but I think when we see something like that right at the moment, I told Jen I wasn't gonna jump in while these guys presented, but she knows me well enough to know that you can't trust me. So
it's okay. As long as you're monitoring it, then I don't have to try to watch 3 different things at one time. So Ed's got us under control. All right. Let's see here. So I think we got through that one. So here's the big question, right? If I had already made some adjustments to my employee staffing, either from a headcount perspective or from a payroll perspective, do I have any remedies? And the answer is yes, you do. So the legislation that's actually enacted in the CARES Act does provide for what we're calling the rehire exception. So if you had made any cuts to headcount from February 15th, 2020 through April 26th, 2020, so essentially, last Sunday, you would have until June 30th to bring that headcount back up to par. And if you do that, then you wouldn't have that penalization against your forgiveness calculation. And David and I haven't had a chance to chat about this offline yet, but there is a little nuance in the legislation that talks about SBA and the Treasury having the ability to provide guidance on a potentially de minimis component that wouldn't be penalized, for lack of a better word. I haven't seen anything come out where they've considered that yet or where they've alluded to what that may or may not be. Keep in mind, there's a potential that it could come. As with all of this, it is changing. It's a very fluid environment. So I wouldn't necessarily get hung up on the fact that you've got one person that has left through natural attrition and you're not replacing them due to the environment. There could be an opportunity where that doesn't cause you a negative impact, but we really just don't know what that impact will be at this point in time. But as the tip says down at the bottom, it is not an employee by employee basis. So just because Joe is let go doesn't mean you have to bring Joe back. You could bring Bob as Joe's replacement back if it was suitable for your business needs. And one thing that I would just like to allude to, the headcount issue, it still needs to make good business sense, right? We're doing this calculation and we're thinking about it from the perspective of maximizing our forgiveness. But we are talking about a forgiveness of a loan at 1%. So if your business can't sustain bringing that individual back, does it make logical sense to bring somebody back just to let them go in another couple of months if it's truly not sustainable for your organization? So I would just keep in mind, I'm a tax person, so the common phrase is don't let the tax bill wag the dog. You can't make a decision simply because it's what you want from a tax answer. So in regards to this whole situation, forgiveness is fantastic. And if you can get that free loan and that free money from the government and it's going to work in your favor, fantastic. But if it doesn't make logical business sense and sound business sense for you, let's take a step back and actually make sure that we're doing what is appropriate, not only for the organization, but for your employees as well. So I would just keep that in mind.
And you're the first CPA I've ever heard admit that, because my father-in-law was a CPA, and to most CPAs, every problem looks like a nail, and they got a tax hammer. So good for you.
Yeah. I try to be a little different, I guess, right? All right. I think that might be the end of my diatribe, and I'll maybe let David take back over if I'm monitoring the slides correctly.
Yep. You
All
bet.
right.
I'll pick up here and let Jen get some water before she dives back into the next section. So documentation, the second part of this section. What we're talking about here is what the bank is going to need when considering your request for forgiveness. So one thing I will say with this slide, as well as the next one, is lenders are all different. We saw that with the application process. We saw it with the calculation process. So this is what has been recommended by the SBA. It is what is included in the legislation. However, communicating with your lender is always the best place to start. So things to have in mind as you are considering how to document and what needs to be substantiated. So full-time equivalent employees on payroll, pay rates by employee for the periods covered. When I hear those two, and we've got a tip on the bottom of some things to consider. So when I hear I need to substantiate those two items, I think of payroll registers. I think that's a great place to start. It's usually all encompassing. So start there with those payroll registers. And then we have payments on mortgage obligations. Again, that's interest. Payments on covered lease obligations, payments on utilities, and then lastly, interest on other debt obligations. So what I'm envisioning here would be to retain a lease agreement that you probably have with your landlord. That is either going to be an annual where you make recurring payments, or you're going to receive a monthly invoice. So retain those monthly invoices. For the mortgage interest, you should get an interest statement either on a monthly basis or an annual, or have an online portal where you can download that documentation. So retain those. When it comes to utilities, everyone nowadays either gets an electronic bill or a paper copy bill. So these are the types of documents you need to be retaining, because you will have to substantiate most, if not all, of those bullet points for purposes of forgiveness. Lastly, I will include bank statements, and kind of touches a little bit on our next topic here. So
Hey, David,
the separate bank account. Yep.
Before you jump ahead,
Yeah.
I think we had some of the most frequently asked questions here are relevant to this section. Some
Sure.
of our thin slicers out there are wondering if utilities include internet and phone. What about company cell phones? What about phone allowances?
So I would include most of those. So right now, it is going to include telephone. And when I say it includes it includes telephone and internet. And when I say those two terms, that is all of the detail that I have, is to repeat that it's telephone and internet. I would expect cell phones to be included to the extent that the employer pays cell phones. I would assume it includes cell phone allowances to the extent that the employer is reimbursing employees who use cell phones for business purposes. So
Yeah,
that's
and documenting that's going to be tricky, right? If you're going to be collecting documentation from every user, I don't know how that would work. It may be one of those. I don't know how much your phone bill is, but
Right. Yeah, it's going to be tough. If cell phone allowances are put through an expense reimbursement process and your company has a documentation procedure for expense reimbursements, I would duplicate that and use that for cell phones and allowances. I think internet and your business phone should be fairly straightforward. Just retain the AT&T or Sprint, whoever does your invoices. But yeah, Ed, it's gonna, the further you get away from the baseline, I think the more complicated it gets. But with reasonable documentation, and again, these are going to be de minimis as well, and they're subject to that 25% limit too. So lots of things to keep in mind. But my suggestion is, as you're going through this, over document, spend those monies in good faith, and communicate with your lender.
While we're here, also, Walt in Georgia, who's I think the only person in America who's lost weight on quarantine, is asking about interest on lines of credit. Interest on operating LLC eligible for forgiveness? I'm assuming he means line of credit.
Yeah. I'd like to know your secret, Walt. I'm not in that club. Yes. So interest on other debt obligations, again, not a lot of clarity. So I will qualify my answer with we're waiting on more detailed guidance. But right now, interest on other debt obligations, I would expect to include lines of credit, bank debt, other types of secured debt.
And Carl asked that same question, so I think we're good there.
Okay.
Okay. Thanks for those clarifications.
Yeah, you bet. All right, so let's talk separate bank account real quick. So, do I need this? The question has come up: Do I need it, or is it a requirement? It is a need. I would call it a best practice. Having that separate bank account tends to take out the noise that you're probably seeing in most of your operating accounts as monies are coming in and out, including AR and payables and lots of different transactions on a daily basis. So by setting up a different account where the PPP loan proceeds reside, as eligible expenses are paid, I think showing those in a vacuum in that bank account simply makes things easier. So it's a best practice. It's not a requirement. That bank statement can be used as a source document. And, we think it's just kind of a nice, clean way to show this. But again, we realize that it isn't practical for everyone, and don't get hung up on the separate account. We would much rather you focus your attention on documentation and developing a routine or a process or procedure where you're looking for eligible expenses on at least a weekly basis, so that you can document those expenditures. So last one here in this section: what if I have a balance left on my loan? This is going to be prevalent, I think, for a lot of companies. Most went out and applied for the maximum loan, which we recommend because you can only have one. But I think some companies are going to find themselves in a position where they do have money left. So two options here. Number one, you can pay it back, as we mentioned earlier, with no prepayment penalty. Number two being, this turns into debt. So it is a 2-year, 1% loan. I think Jen mentioned it's cheap debt. It's not, in my opinion, the end of the world. So a couple things on that real quick before I turn it over is businesses really need to consider their new normal once this forgiveness period ends. Because if you have a restaurant, or you're in retail, or you're in a non-essential industry that has been completely shut down for 8 weeks, I don't think come July 1st, you're going to be roaring back the way that you were. Unfortunately, I think that is going to be the reality. I also think you're going to have industries that are going to face a downturn for much longer than 8 weeks, probably 4 weeks, maybe 5-6 weeks. So it's it's great to pay employees, but my personal opinion, and I'll say not that of Jen or BSW. If I got $100,000 and my decision is to pay people that I know I'm going to lay off in 8 weeks, or spread that money out over the next 6 months that I know are going to be difficult, might make a difference between my business being around any longer, I think I know what decision I'm making. So something to keep in mind as monies are left. It's cheap debt, and it might come in handy given all the uncertainty. So 2 cents on that. So we'll move on to the next section. Jen drew the short straw, so she gets to talk about journal entries.
Yeah, we might, given the nature of folks participating, we might fly through these pretty quickly. Nobody likes to talk about debits and credits and be reminded of their college accounting days, but count myself included. So we'll go through them as quickly as possible, basically just to give you some insight so you've got a little bit of background as you're going through, and if you have to have any insight on the finance side of things. So we go ahead and flip on over. So you do obviously have to record this loan on your balance sheet. So it is something that you would have documented within your financials. You're going to have that current portion of the loan on the books as well as the non-current portion. And just a reminder from the accounting world, if it's current, it's going to be satisfied within a 12-month period. And if it's a non-current, it's going to take longer than 12 months to get that off of your balance sheet. So we would see that as a recording on the balance sheet items. If we go to the next slide, you will be accruing interest. So as we said, there is a 6-month deferral for the payments on the loan, but the loan will start accruing interest from the date that you receive the funds. So that first disbursement starts day one of not only the 8-week period, but essentially the interest accrual. So as David mentioned before, you will want to make sure that you've read through your loan document. The loan document will likely identify if the lender is utilizing a 360-day year or a 365-day year. The only implication there is how you are actually calculating your interest accrual component. So you would debit interest expense and credit your interest accrued that's payable. So that will be part of your month-end closing each period. We go to the next. So if I'm actually able to successfully get my loan forgiven, which would be a great thing, then you will need to remove the loan and that liability then from your balance sheet. So we've got the activity on here for extinguishing that debt from your balance sheet. The tip on here is to keep in mind that the forgiveness of the loan at this point is being deemed to be a non-taxable event. So usually if you're forgiven a debt, it would be considered what we call cancellation of indebtedness income. The legislation has indicated that that is going to be a non-taxable event for this forgiveness. So the tip just would be you do need to record it as a financial item. So gain on extinguishment of debt. You do want to make sure that that's kind of a below the line. So it's not improperly inflating your operating income. We go to the next. The other thing that you're going to want to keep in mind is you will be getting a letter of that loan forgiveness from the bank or the lending institution. If you have an audited financial statement, your auditors will want to see that. So definitely keep that as part of your permanent records. So that way there's no question about that debt being forgiven. Best point is to keep it as part of a permanent record, keep it as part of your loan application where you're documenting all of your usage of your funds. Just keep everything together so that there's no question of where that is or when it came into play either. We go next. So for most organizations, if you're operating on a calendar year end, the issuance of the loan as well as the forgiveness of the loan will happen within the same year. So you wouldn't likely have any end of the year footnotes that are required within your financial statement. But if by chance you are a fiscal year end entity and the issuance of the loan occurs at the end of a fiscal period and then the forgiveness happens at the beginning of the next fiscal period, you might have some overlap there. So you might have an extra footnote disclosure that's required as part of your financial statements. If you do, there's some pretty simple boilerplate language that would go into disclosing that information. On the other side of it, you may also run into some additional footnote disclosures just simply from a going concern or a subsequent event position in relation to COVID-19. So just some things to keep in mind from an overall financial reporting perspective. We'll try to keep moving through these quickly so I don't bore you. If by chance you didn't have all of your loan forgiven, then you just go through the same process that you would for any other loan that you have on your books. You will keep that loan out there until it is fully extinguished from the payment perspective. You'll have some adjustments for your accrued interest that is now being paid once you're into the payment cycle. So we've got those journal entries on here as well. All right, let's see here. Then, so the federal tax implications. So I alluded to the fact that the legislation has noted that the COD income is not going to be typically taxable. There's been some speculations as to whether or not there might be some attributes that are adjusted due to the forgiveness of the debt. So the little tip that we have down here is in reference to Internal Revenue Code 265. And I don't like to quote code because I'm not very good at it unless it's from a nonprofit perspective. But 265 does also allude to the fact that in a case where you have tax exempt income, the expenses related to that are typically not allowed. So think in terms, and I'm going to pull this maybe back to a personal perspective. If you have tax exempt income from an interest perspective, maybe you've got muni income that you're receiving. Back in the day when we could actually deduct expenses related to investment advisory fees, you couldn't deduct those if it was related to tax exempt income. So that's what this is referencing. The allusions that you might hear to 265 say, if I have now paid advisory fees or other expenses, payroll, utilities, rent, all of these things with income that is now non-taxable, am I now not actually able to deduct these from a tax perspective? That would be a big slap in the face to a lot of organizations. I mean, that would just be a kind of unheard of component, but it's something that's being rumbled about and is being talked about. So rather than just completely glossing over that situation, we do want to draw it to your attention. It's something that's being discussed. I think it would be a horrendous step in the wrong direction if it were to be something that comes to fruition, but just be aware that it is potentially out there. So we go to the next. So the next question is, we've said that the IRS theoretically would not treat this as federally taxable income. So then the question is, what about the states? Because we know with every round of tax legislation that comes, usually the states either say that they're going to conform or that they're going to not conform with what the federal government's doing. So I know our audience likely is spread out among various states. Unfortunately, we can only comment on what Illinois and Missouri are doing. There's a lot of different rules for the different states. So some states are what you call a rolling conformity, meaning that they will go with what the IRS and the federal regulations are unless they decide to disband based off of specific legislation. So Missouri and Illinois do have rolling conformity. So as of right now, Illinois and Missouri would be stating, we're going to follow the same as the federal regulations. Other states have what's called static conformity, and that means that they have their set legislation in place, and it takes them passing a new law to exclude or include something from a taxable component. So we do have folks in our firm that are focused solely on state and local taxation, and we'd be happy to get them connected with you if you have a specific question in regards to your state. But otherwise, this at least gives you some insight for Missouri and Illinois. All right, I'm going to turn it back over to David, and he's going to maybe address some of the Q&As that we've seen. I think some of these we've addressed kind of as we've gone along, and then assuming that we still have a little bit of leeway in time, then Ed will turn it back to you to have any other live questions that might be appropriate.
Yeah, thanks. And one thing I'll add too on that state piece is if there's a website out there and an organization referred to as the Tax Foundation, if you Google static rolling conformity states tax foundation, what should pop up is a nice little map of the US, and it's color coded that shows you whether your state is rolling or static, or sometimes it's referred to as selective. So that's a nice way just to get a quick high level of where you think your state may be. And then you can dig into that with your CPA a little bit further. So as Jen said, we have a few questions. We've answered probably most of these. So if we've answered it, I'll move on, or at least do these really quickly. And if you guys look at the slides, you'll be able to understand the deck. So a lot of questions on is this cash or accrual, or how does timing work? So this is at a really high level. I would focus from a payroll standpoint on the pay dates that are included in this period. So if I received my money yesterday, and I'm a weekly payer, my Friday payroll is probably for last week, right? So don't include that. Payroll next Friday is going to include this week, of which 3 days or so are included. I would analyze those payrolls that straddle the cutoff periods from loan issuance as well as the end of the 8-week period, and do some sort of analysis to say this many days from that straddle payroll are included on the front and on the back. The gut check is over 8 weeks. Generally, most of us work 40 days. You should have about 40 days of payroll is a good way to look at it. You should have 2 months of utility invoices. You should have 2 months of rent expenses. That's a nice way to, once you do all the complicated math, dig into what is reasonable. And again, bounce those off your lender, bounce them off your accountants, send emails to Jen and I. We're happy to answer questions. So please ask. So next one, payroll benefits include dental and vision. We've got an explanation in here. So they are not explicitly included and not explicitly excluded. Our opinion and interpretation is that dental and vision are so closely tied to health insurance and what we would consider healthcare benefits for employees that we think there's a reasonable argument for including this in eligible expenses.
How about 401k? Matt?
401k, yes. So SEPs, simple IRAs, 401ks, the employer portion of retirement benefits is includable in eligible expenses.
Good.
Yep. We touched on interest. We touched on leases. So here's the definition on the screen of what is a utility: electric, gas, water. Just ignore transportation. It's more confusing. Chances are you probably don't have it. If you think you do, again, ask your accountant or send Jen an email about that. Telephone, again, we think inclusive of cell phones used for business purposes as well as internet. All of these services had to have been in place before the 15th of February. And then,
hey, David, let me interrupt you for just 1 second.
Sure.
We're at 3:28.
Yeah.
So I want to be respectful of everyone's time. We gave everybody an hour. We have got a few questions here that are pretty specific that have been upvoted quite a bit. So I really feel like I want to answer them very quickly if we can.
Yeah.
And if you guys have a little more time and people can hang on longer, do you have another 10 minutes or so?
Yeah, I do. And,
Okay.
and like I said, these are in here. We've got resources, so
Well, let me hit these couple that are really hot buttons, apparently, for a lot of folks.
Yeah.
Eric and 11 other people asked, can a quarterly bonus be included in the 75% compensation calculation if these bonuses were also included in the payroll calculation used to come up for the loan amount?
Yeah, so bonuses and raises and different compensation components are being asked about a lot. So what I will say is that this program is going to receive some scrutiny. The recipients are going to be subject to the Freedom of Information Act because it is public money. What I would say is for all borrowers to consider the optics of giving raises to employees or giving bonuses to employees that may be perceived as them accelerating costs into the forgiveness period, or potentially questioning their certification that this loan was required to maintain ongoing operations.
What about employees who are 100% commission?
Yeah, commissions are fine. Yeah, commissions.
So Those are, yeah,
Yeah, those are two different things. So what I will say is this: if in your normal course of business you give out bonuses and you do standard of living raises and you're doing and you've done them for years and it happens to hit in a period that's forgiveness, I think you're fine. What they're going to be looking out for, and by they I mean auditors or whoever comes in to take a look at this, if they do, are going to be companies who tried to say, well, I normally pay a $100,000 company-wide bonus in December. I'm going to pay all 100, coincidentally in the forgiveness period and get it all forgiven. So I think there's a line that everyone needs to toe. Consider the risk versus the reward, and just do what you've been doing. We've also had clients ask. It's been a stressful time. We have a lot of employees that are stressed out. I'd love to give my non-executive, non-highly compensated folks $500 each. Am I going to get in trouble? And again, I'm not the auditor, but I think if you're reasonable and you do it in accordance with past practices and you don't discriminate such that, the owner of the company got a $15,000 bonus coincidentally, I think it's going to be fine. So long way of answering, but things to keep in mind as you're doing this. Commissions are certainly included, bonuses, past practices, just lots of things to keep in mind. And like I said, if you have specific questions, please don't hesitate to reach out. We're available. We'll give as much of an answer as possible.
Yeah, I think a lot of this has to do with incentive compensation for salespeople. Yep. They may be paid a fairly low base amount and have certain thresholds where and it's called bonuses, but it's essentially a commission. So it's I think that can be part of the ambiguity there.
Yeah, I think the big thing is just the intention is, let's not try to be cute about it. We don't want to create something that it really isn't. But as long as it's your normal business practice and it's something that you would normally be doing, you've got a little bit more leeway. Again, a lot of this is you did it in good faith. So from the optic perspective, what would if the business down the street saw all of the transactions that you did with this money, or it was broadcast on the newspaper because it is, freedom of information, it's not going to be from that component. But if it was, would you feel comfortable? And if you would feel uncomfortable with the transaction, then you probably shouldn't be doing it.
We've got some ESOPs out there. So I want to hit that because that was 7 people wondering, are ESOP contributions a qualified payroll expense? If we typically make a cash ESOP contribution in October, can we now make this in May or June? Should the early contribution be limited to a prorated 8-week amount, or can we make a larger contribution?
So ESOP,
ask your accountant.
Yeah, it's a very specific question. We do have ESOP clients. I have gotten ESOP questions. Guidance has been provided on eligibility of ESOPs. Guidance has not been provided as to, they list out 401ks and SEPs and simples. They do not speak to contributions for ESOPs. So I would wait for more guidance to come out before, feeling comfortable to answer that.
No, fair enough. Okay, we've gotten a few questions about temporary hires, short-term hires, new hires. I guess the ruling principle here is it doesn't matter who you hire, the amount of your payroll is what matters, right?
Yes, I think. So what matters is your payroll in total, and what matters is your full-time and full-time equivalent headcount total relative to the base period. What I will say is there are some planning opportunities out there such that if you lose headcount and have employees compensated in excess of 100,000, that can be reduced in pay to bring headcount up. There are companies that are doing that. That would fall on a lot of hourly workers as well as skilled tradesmen, who are making good hourly wages. So It does matter. It doesn't have to be the same people. It really just comes down to the math of, did you maintain headcount and did you maintain payroll?
Got it.
So, and one thing on temp, so be careful with temp agencies, bringing in temp agency employees to think you're going to make up your headcount. I have not seen temp agency workers includable in headcount as the guidance stands right now. So don't think of that as a loophole unless you see guidance that says that's allowable.
Got it. Hey, Jordan, did we get your answer? Or unmute, Scott, unmute Jordan. Jordan, talk to us.
Yeah, I appreciate, so yeah, some of it, yes. Did kind of want to understand a little bit how you're talking about that. We know retirement benefits are acceptable to be paid those expenses, but that also includes profit sharing contributions that are generally paid not during the year or during a forgiveness period, but most likely and most commonly profit sharing contributions are made after the end of the calendar year or plan year specifically. So similar to almost like pre-funding that plan contribution, what you're saying, that's an acceptable contribution because it is for the year where the forgiveness period is in. So are you saying that they should give a prorated contribution amount for an 8-week period? Because maybe that would be an acceptable way to give a mid-year bonus or mid-year gift, something like, either hazard pay for people who are working during a stay-at-home order, or dealing with, an employer who's trying to help their employees during, economic hardship, or because we've lowered their pay, trying to somehow give them more than a regular payroll. If we, accelerate their payroll, it's because it's because this PPP alone is allowing us to really help and maintain payroll for people. If we've already cut their pay during the 8-week period, it would seem to be specifically the absolute right time to make them whole again.
What do you think about that, guys? I obviously I can't answer that.
Yeah. So I think, so when you say cut their payroll
So
and then make them whole, is that, go ahead, sorry.
We reduce some salary people. So we reduced their salary by a certain percentage. We reduced hourly people. Instead of working 40 hours, we reduced them to 35, then 32, because our goal ideally was to keep, again, the ship afloat, the business, and keep as many people on the ship as possible and not out in unemployment. So if that meant working a little less, but keeping them employed, keeping them on healthcare, that was our goal. So they've gone maybe 6 weeks, 7 weeks, where they've made, maybe it was 5 hours less a week, 10 hours less a week. So they were losing income and payroll during the year. Now, if we were to then pay them, not necessarily back pay, but give them some sort of payment, as if it's, look, we have some people who are coming into work, even though we in Michigan have a stay-at-home order, because we're considered essential, as everybody on the call probably is as well. But the idea that it's not trying to accelerate a year-end bonus, but specifically we're trying to help people so they're not, suffering or being harder hit during these economic times.
Right. So I'll tell you what, let's take that one offline. Unless you guys got a quick answer, we can get back to Jordan on that after the call, unless there's an easy, obvious answer. But that sounds like a pretty specific instance.
Yeah, I have an answer. I don't know how brief it is. So yeah, why don't we talk offline?
All right, Jordan, we'll catch up with you. I think I know where you live. Thanks for dialing in. All right, it's 3:40. I'm gonna go with one more question here that has been upvoted. A lot of questions about annual bonuses. We covered that. Someone resigns, not a layoff, that impact the loan. Again, I think it's your overall payroll, right? That is what impacts the forgiveness. And okay, if you have ability to hire staff who were not on your payroll as of your loan date, are those payroll costs still included in the forgiveness calculations?
You have the ability to hire staff.
So in other words, when I submitted for my loan, I had X number of people, and then since I submitted, I now have X plus 2 people. It's during the covered period. It's your payroll during the covered period, right? No matter how you got there.
Yeah, it is payroll during the covered. It's payroll during the 8-week period relative to payroll for most Q4 of 2019. So as long as that wasn't reduced by 25%, you should be fine on forgiveness, if I'm reading that question correctly.
Yeah. Here's another question about business need. I think you guys have touched on that. The bottom line is, if you're F&M Electric in suburban Connecticut, I don't think CNN's going to do a shaming campaign against you for your business need. That's really guided at Shake Shack, right? It's like the idea behind this loan thing was to make it really simple and to get people money so they could keep people employed. I think common sense. It's easy for me to say common sense applies. It's not my money. Well, I guess it is because I'm a taxpayer. But but is that accurate, guys? This is the shaming for the business need. If you're close, you're probably going to be all right.
Yeah, it is. And the SBA and their FAQs, question 31 really drills into this related to Shake Shacks of the world receiving money, Roof's Hospitality, the LA Lakers apparently got a loan, which is insane to me.
Yeah.
So that's the public shaming. To your point, electric company in Connecticut, I don't think it's going to happen that you're going to be on CNN. I don't think it's on their radar. What I will say is if this was me taking a loan, I think the most basic question to ask yourself is, if I didn't get this money, would I have cut payroll or cut headcount at some point between now and July 1st? And, because the issue with business need and sources to capital is just because an owner has $10 million sitting on their balance sheet doesn't mean they're going to become altruistic enough to give all that money to employees who aren't working, right? I mean, you make business decisions to control and direct the future of the company. So if this money went from the government to you and you paid it to employees who would otherwise be laid off or making less, I think you've done what the act was intended to do.
And the bottom line is our industry lags the overall economy by a quarter or so. And so we got harder times coming.
Right.
And I don't think the feds are done trying to support us keeping people employed. This is an odyssey. And so we're not quite sure what the next step's going to look like, if they're going to continue the PPP or if there's going to be some other program. We've seen other legislative proposals floating around to just, the bottom line is here, we're trying to keep it from having a 56% unemployment rate in the third quarter right before the election. So their interest is in keeping people employed. That's what we're trying to accomplish here. So I think, for our perspective, it's probably going to get worse before it gets better for most of our members. So keep your powder dry, stay healthy, try and collect as much money as you can, hang on to your cash. And thanks, Jen and David, for a spectacular hour and 15 minutes under the microscope. You guys really appreciate it. We're going to keep track of all these questions, and we'll try and do a Q&A working with our friends there at BSW. They'll start the clock on us, but man, they've given us so much time already. We couldn't ask for any more. A lot of great questions, folks. Keep them coming. They've indicated that they're willing to help. Of course, NAED is willing to help any way we can. I'm going to let everybody go right now. So stay safe and stay healthy and don't stop believing. Thanks, everybody.
Thank you.
Thank you.